My people are destroyed for lack of knowledge, because you rejected knowledge. Welcome again. In this video, I will be going over terms that you need to be familiar with. By knowing these terms, you can speak intelligently and be able to understand when someone is speaking Forex or using terms related to trading. Here are some of the common terms that we'll be going over, and if any comes along, it will be explained. A lot size is the amount that you put into a trade. A standard lot size is equivalent to 10,000 units of the base currency in a Forex trade. It is one of the three common known lot sizes. The other two are mini and micro lot. Lot size refers to the batch of currency the trader controls, based on your account, how much a trader is using to trade. Big lot size, big gain or losses, and the same for small lot size. So in this example, using Euro USD at 1.21, the base is Euro and the quote is USD, which means 1 euro can be exchanged for $1.21. And here are the ask and bid, as you will see on your platform, buy and sell. So the same as you will see here. And we will go over ask and bid as we move on. Point, tick, and pip are terms used to describe price changes. A pip is the abbreviation of points in price, or better yet, percentage in point, and is the smallest unit of price movement in the foreign exchange market. So let's look at this example. Euro USD moved from 1.2108 to 1.2110. The currency went up 2 pips. Also, 10 points is equal to 1 pip, and 100 points is equal to 10 pips. The conversion is very simple. You either dividing or multiplying, or better yet, you'd be adding 0 or taking away 0. Very simple to convert points into pips. Ask is the current buy price, and bid is the current sell price. Short is selling, long is buying, bullish, uptrend or on the rise, bearish, downtrend or receding. And as you can see, ask, buy, bid, sell. Spread is the difference between buy and sell of a pair, and is different for each broker and account type. Spread can be influenced by many factors: the supply of asset, trading activity, and the total demand of interest in that particular asset. Let's take a look at spread on the platform. As you can see, I have 3 different platforms open from 3 different brokers, and you can see the difference between the bid and the ask, or the buy and sell. And as you can see, here is 12 and here is 7. And if you don't see it on your market watch, just right click anywhere and just say spread, and it will show you the spread. So Euro USD here is 0, but you have 7 from this broker and 12 from this broker, and this can affect your trading when it comes to making profit. Since price movement is very tiny, in order to make good money, you have to invest big. That is when leverage comes into place. Leverage is funds loaned to you by your broker. Leverage allows you to deposit a small amount and trade with high volumes. The term ultimately means borrowing money in order to increase the potential returns on the trade. But this means losses get increased too. You can gain big or lose quickly based on your leverage. If you have a leverage of 100 to 1, it means for $1,000 deposit, an investor can trade with $100,000 in a particular currency pair. And there's also margin requirements that you have to trade within. Leverage and margin varies from broker to broker, and we will go in details when we talk about brokers. Slippage refers to the difference between the requested price of a trade and the price at which it was executed, or when an order is filled at a price different from the price entered, and this is caused by constant price movement. So let's take a look at on the platform how slippage might look like. So slippage is when I go make a trade and I get a different price because price is constantly moving. So if I make a sale and I get a different price other than what I actually wanted, that is a slippage because there is a movement in price. Swap is an interest fee that is either paid or charged to your account at the end of each trading day. So if you have a trade that goes into the next day, you're either being charged or you're being paid. Scalping is best suited for those who can devote time to the market, stay focused, and act swiftly. It's quick and taking advantage of small opportunities in the market. These are quick buy and sell orders. Swing trading is long-term trade. It involves identifying a trend in the market. Hedging is a technique designed to reduce risk caused by price fluctuation. It is done to offset or balance your current position. This is when you buy and sell the same currency pair at the same time. Some forms of hedging and forex trading is deemed to be illegal in the US, and regulated brokers do not allow that on their platforms for US citizens. Drawdown refers to the difference between a high point in your balance of your trading account and the next low point of your account balance. Simply how low your account goes and how low your equity get when trading a pair. Trailing is simply a way of securing profit and lowering your losses. This is a continual modification of stop loss after each gain. Break even is another way of securing profit. In this method, the stop loss is moved above the initial position. Let's go on the MT4 and take a look at these. So remember, hedging is having both buy and sell for the same pair. So here I have a sell, and when I do a buy, which means I'm hedging. And for trailing, if my trade is in profit, since I have a sell here, if I move it below my initial position, I secure some of the profit because I'm already in profit and I can secure what I have, and I'll follow it as the price keep going down. That is known as trailing. So I'm trailing my profit and I'm securing it. So when it turns back against me, I can still get out of the trade with profit because I started from here and I did a sell and I trail it all the way here. When it turned around, I make profit. And break even is very similar. Is when you move your stop loss below your initial point if you're doing a sell. And if you're doing a buy, you move it above your initial starting point. So you can secure a profit just in case the market turns around. And that's it. I'll see you in the next video.